we know why they're doing it. It's because of inflation, right? They're trying to bring that number under control. What do you see happening now with like the interest rates? Like I think they have an announcement scheduled
in
for
October,
and November, right?
Yeah, by talking to people, I don't think so anything may happen in October, but I think in November we may have a rate increase.
Right.
But it is an affordable issue. Let's be honest. Like it is an affordable issue for a lot of people, right? Inflation has gone up. That's mean cost of groceries has gone up. Gas prices has gone up. So monthly cash flow is getting tight for a lot of people who's on a set budget.
Yeah.
So we may see some people unfold.
Yeah.
We don't. We hope not.
Yeah.
So we don't know what next 6 to 12 months going to look like.
Yeah. Talking about like maybe there being problems with people that have mortgages out there, it's hard to kind of get a clear gauge right now on like delinquency rates as of right now. Like, I mean, I don't think we've seen any huge headlines on people folding or anything else right now. Interestingly enough, it's okay. We had a conversation. Like basically, the way that I understand it is that if you start to see trouble in the market, you're going to probably see it, like you were saying, from private. It'll probably start off at private lending, then it'll go into B lending, and then you'll see the A lenders affected,
That's right?
Because it's just the way the title is registered.
The risk.
Yeah, the risk.
Yeah.
But the thing is that even talking to one of like a private lender that you know, basically he was even saying that I think like if it's okay to say the number, it's like $50+ million that they have lended out, right? And in the last 60 days, it was only about
0.05.
Yeah, $25,000 in missed payments.
That's
so
like a 0.04%.
Exactly, a very, very, very low percentage. But that's the last 60 days, right?
Yeah, but we don't know what the future is going to look like.
Exactly, and we're kind of trying to look out for it right now.
And also keep in mind, like over the last, like the rate started to increase since April.
Yeah.
So they may be using the savings or the help from the family to keep up the payment. But to the point, a lot of people kind of unfold in the last minute. Like they may not have any backup plans. So that's why the problem may happen.
Yeah.
We hope not. But also keep in mind we are approaching the holiday season as well. So we don't know how that's going to hold things up in the new year.
But I think one of the things I guess we do understand is that for sure the rate has gone up, and I think we're both in agreement, and I think everyone is in agreement more or less that the rate's going to continue to go up.
Yeah.
We don't know for how long, but I think that we could probably see at least one, maybe two rate increases still before the end of the year.
But also on the flip side, the rate has to come down as well.
Yeah, I think it will. But like in the sense of like I think people are definitely feeling a pinch right now, right? Like in just terms of like strategies, like what can people do right now? Like one of the easiest answers I would have for people and would be is just like budgeting and trying to make those cuts in your lifestyle that were like a little bit like you don't really need them, and just trying to cut back and budget a little bit better. Like I think that's one of the things that people can start to
100%,
do.
right? So pretty much we are dealing with inflation. We are trying to reduce the consumer spending, and that's pretty much going to have an impact on it. So it's not going to affect the clients who are on a variable rate. Like you could have a 5-year fix that's coming up for renewal next year. You would have had a 2% on a 5-year fix, but in next 6 months, you're going to renew the same mortgage at 5.5% if you believe in a fixed term mortgage. So it's not, the issue we are dealing with is not just for the clients who is on a variable rate mortgage. It's for everyone.
It's just the fixed one feels like it's a little bit delayed. You're delayed to feel that pinch.
But I think we kind of feel overwhelmed because a lot of clients over the last 2-3 years during the COVID, they took a variable rate.
Yeah.
And I personally, like it's my opinion, I personally believe in a variable rate over the long term. It's too early to predict is it the right product or not because of 5-year term, right? So anything can happen over the 5 years.
Sure.
And also, there's a lot of clients, they were taking a B mortgage for 2.89, 2.99%. They took a 1-year term. They don't want to go in a 3-year term. They thought they can move to the different lender. So they're renewing the same 2.99 into 6.5% right now.
Okay.
So you can imagine how much of an impact they're going to have on the payment.
Yeah.
So use a savings.
Yeah.
If you don't have a savings, in my opinion, it's okay to leverage into a line of credit or other credit facilities to keep the payment going for 1 or 2 years. I don't know what the long term, how long the market's going to be to get the values back. Use your savings, use your debts, or use your help from family to keep the payment rather than selling. Because I think it's not a wise idea to sell in this market because you have more to lose, even though you are kind of dipping into your line of credit to keep the payment going. You probably see where I'm coming with this. At the end of the day, the cost of borrowing on a line of credit of 50,000 or like what are the money you need for a short term is actually much less than what you can give up on the price of the home right now.
Yeah, actually, we were talking before too, and I think you brought up an interesting point. Is like, instead of like having to refinance, right? Like if you need to get some cash, and instead of refinancing, maybe if you have a 2.5% or 3% rate, it might actually make sense to get a second mortgage
Yeah.
for whatever you need, $50,000, $100,000, but maybe it's going to come at a much higher rate. But when you blend it all together, you're actually better off
Taking a private mortgage than
taking
going
a
to the
smaller private mortgage instead of refinancing the whole amount.
when you refinance, you're going to go from 2.5%, 3% to 5.5%, 6%
On a bigger
on a
number.
bigger number.
Yeah, on a
right? So
bigger
it's
number.
better to stay put.
Yeah.
But a lot of people may not think it's a good opinion to dip into the line of credit or credit facilities to keep the mortgage payment going. If you are back against the wall, if you don't have any option,
Yeah.
why do you want to sell a house right now? You can, let's say for example, you have a $300,000 mortgage, but your property worth $1 million.
Yeah.
But the same property can worth 1.4 million dollars in a good market. So
Yeah.
why don't you dip into your line of credit or some credit facilities that may cost about $25,000-$30,000 to cover the payment for next 1 or 2 years?
Yeah, and the thing is that like I also want to be very clear with people that are kind of watching this. Like this advice is for like a certain type of market as well, right? Like I've been in a situation before where somebody basically. Let's just say like wasn't doing proper management of their money or whatever else like that, and they come to a period where like I think you clearly understand that you don't have a choice, but you have to sell your property. I mean, for both of us, our mentality is that hey, try to retain your asset as long as possible, because the asset class that we're dealing with, we know in the long run they actually go up. But I think if you're really going to start to really get yourself into a bad position, you have to be able to kind of stop it at some point.
We
as
are
well.
not telling you use your line of credit to keep the property, but if you can see a future with that, just do that.
And I think that's what's going to be very important right now, is to be very real with what your spending is, what your income is, and what your risk level is. I think these are very good things to evaluate right now and decide on how you want to kind of move forward.
And we've seen this, right? In 2017, 2000, even just before COVID, like people who kind of sold and gone, they regret they could have used some different options to keep their property.
A lot of people, and I know a couple of people that can't even get back into the market, even though that the market has come down 20-25% now, they still can't get in because they got out of the market originally.
It may sound stupid, use a line of credit, pay the mortgage or keep the house, but the thing is, to the point, you may lose your home ownership if you kind of miss it out.
Exactly. So along those lines, like obviously we're talking about like in order to protect yourself, we're talking about budgeting correctly. We're talking about possibly going into line of credit or borrowing funds in order to kind of, if you can see your financial forecast kind of getting better a little bit in the next 2 years or so, maybe try to float yourself a little bit. And I think there is another option over here as well. Like we're talking about is that it's not comfortable when you make these kind of changes, especially I guess when people have families and stuff like that. But if you have a house that can rent out for, let's call it $4,000 a month or whatever else like that, but you can go get a rental for $2,800, that might not be where you want to be at right now, but you have an option of saving your property, reducing your expenses at the same time. This could be another strategy for a short-term period. Well, you can kind of figure out where the market's going.
I actually advise our clients, if they have before you sell, explore all the options.
Yeah.
You may have to swallow your ego to do that.
Yeah.
You can have a mom and dad or sibling or some immediate family member. They have a space to take you in for short term.
Sure.
And you can rent your house out and you can cover the mortgage payment and the taxes. With the rents are also going up because of inflation. So you may not able to, you don't need to put $5,000 out of your pocket to keep the house. Maybe you may have to put $1,000 out of your pocket.
Yeah.
But these are the options to keep your asset rather than cashing it out.
Yeah, and in a longer theme, and again, this is like our opinion, right?
It's our opinion.
About like how we would handle our assets. But and again, we're thinking from a long-term perspective. Like as long as like you can figure out a path for the next 2-3 years. Like I think if we look forward in 10 years, like Toronto Real Estate Board has a history of 102 years, I believe, right now, worth of sales history and average selling prices and everything else like that. Almost in any given 10-year period of time, the real estate prices have doubled. We've gone through wars, recessions, pandemics, all kinds of crazy things, right? But the thing is that the prices still doubled. What we're really talking about addressing right now is the next few years. I know it's a big deal, and especially when you're trying to get through it, it's a very tough thing.
It's very stressful.
But if we're thinking with a mentality of we're thinking 10, 15, 20 years down the line right now. We're just absorbing this pain right now to ensure that we have a more successful financial future.
I strongly believe there's still a shortage of the houses.
There is,
There's
yeah.
still immigrants. Immigration is still
Yeah.
huge in Canada. I talked to one of the big builders. They believe in immigration and they believe in the shortage of the houses. So, in my opinion, once
Yeah.
again, it's opinion. I don't think so.
This is all opinion, guys.
It's all opinion.
Yeah.
I don't think so. We are going to see a
Yeah.
crash.
Yeah.
We will see balancing, but we may not see a crash.
Sell it, sell it, sell it, sell it, sold. Sell it, sell it, sell it, sell it, sold. Sell it, sell it, sell it, sell it, sold. Sell it, sell it, sell it, sell it, sold.